You're listening to Biotech Hangout, a live and unedited weekly discussion of all the latest news in our industry with a group of biotech insiders. I'm Brad Loncar, and my co hosts today are Eric Schmidt, hopefully, Tess Cameron, Tim Opler, Luba Greenwood, and our special guest, Adam Feuerstein. For more information about our hosts and guest speakers, or to listen to the most recent episode, please go to biotechhangout.com. I'm sorry to say, I think this is going to be pick on the biotech sector day. Albert Bourla was booed at an event at the White House yesterday, and I think that's kind of the tip of the iceberg of negative things that happened and just kind of the conversation about our sector this week. We're going to kick things off with a really cool discussion about a story that I know everyone read. It was excellent that Adam wrote at Stat News about zombie biotechs and how when biotech companies crash out, oftentimes they think of creative ways to use their large cash piles that still exist. So Adam, I'm going to kick it over to you. Again, everyone I know read that story, and it raised a lot of emotions and opinions on both sides. Just give us a brief summary, and then let's jump into a discussion about just this topic and how people feel about it.
Yeah, thanks, Brad, and thanks for having me on today. It's just not a new, it's not a new topic, and it's something that I think we've all talked about probably in the past. And these are, and by biotech zombies, and Eric has used the term as well. Others have used the term, but what we're talking about there are companies that trade at a negative enterprise value. So essentially, their assets are worth less. The equity in the company is worth less than the cash that they have on the balance sheet, and oftentimes that situation arises when companies have biotech, they have significant setbacks, right? Clinical setbacks with their pipelines, and it's just sort of indicative of kind of, I think, this overall issue that we just have in biotech. I like I said, I track about 700, give or take, public biotech companies, and about 200 of those trade at a negative EV in some form or another. So I guess that's the sort of army of zombies that we are talking about. And as you mentioned, it's a question as to sort of what to do with these companies and why they continue to exist, and whether those companies can turn themselves around, or whether those companies, the capital, the money that those companies have should be, either returned to shareholders or used in some more productive way.
All right, let's open the floor for people to just kind of jump in and, tell us what you think.
Yeah, well, maybe I'll jump in. I thought there were some really good discussions online, on X about this. There was a good, exchange, Daphne and John Maraganori and a few others, where how do you know when something is a zombie, right? So maybe it looks dead on the outside, but can you always tell, right? Because we've seen some incredible kind of zombie transformations. We're like, wow, that company, maybe it looked like a zombie for a while, but it really wasn't. And I thought it was, great that John kind of mentioned that for Alnylam. And, I'd be interested. I mean, look, as an investor, we are always looking to find companies that look like zombies, but aren't, because, those can create pretty interesting opportunities. I point to Taysha as probably one of those, where I think that company had been trading below cash for some time, and we, along with other investors, were able to kind of see an opportunity with their gene therapy, program for Rett syndrome, and voila, the company has reemerged and is back to life. So, Adam or others, how do you know if something is a zombie, or if it just looks like a zombie on the outside but really has a lot of life in it?
So Tessa, I love your perspective, and I think that's a great question. And a lot of the times it's actually sometimes very hard to tell, but also think that many investors are just very quick today to write off companies that, if they actually looked hard enough and looked at the data, are not really, maybe they're zombie-esque, but they're not really quite there. And you're absolutely right. There's so many great comments from John and others. There's another one on X about talking about, look at Jazz Pharmaceuticals or Pharmacyclics and Neurocrine, and Immunomedics and a number of other companies that you could have called zombie at the time, but have done very, very well. And of course, these are just some, and one could argue, well, that's good that you're calling out 10 companies, but what about 100 of the other ones? I do have to say, being on boards and investor in some of these companies that one may call zombies. I mean, one of the things that these companies do is they are forced to truly focus and have a hyper focus, and hyper focus plus survival and working very hard. And so what you have is the team that's usually left standing in many of these so-called zombie companies are really determined, and they do miracles, and they also focus just on one program, not on two, three, or four. So I think that a combination of very strong teams that are remaining, plus hopefully there are some investors, Tess, like you, it's great to hear that you're working on that, and picking out some of these companies and putting some money into them so that they can come out stronger than they even would have otherwise.
I mean, I expected a defense of zombies coming on this call, just given the people that given you guys' backgrounds. And I think yes, you can point to companies that are exceptions and that are not really zombies, or just temporary zombies, whatever term you want to use. I think some of the ones you raised are I wouldn't put those in those categories. For instance, Immunomedics I wouldn't put in that category. I don't think that they were a zombie. I think that was actually a case of an activist investor coming in and throwing out an incompetent management team because they knew that the drug was working. I think that's not a zombie. That's not a zombie example. But I think, again, I think these are some hard things I think that the industry has to grapple with. And I think that when you look in the aggregate, there's a lot of money that is wasted, whether that's because of arrogance, because of greed, because of people who don't want to give up their positions, who think that they know better. The example that I used in my column this week, Cargo Therapeutics, that as a no fault of that company. No one is saying that the company shouldn't have been formed in the first place. There was strong scientific rationale. It had very sophisticated investors who backed that company, but they backed it for a very specific reason. And that experiment was run, and the experiment failed. And I'm not the only one saying that Cargo should be shut down. I talked to many of the company's largest shareholders, and they want the company to be shut down because they said this is what we funded. It didn't work, and we're not interested in whatever else they're going to be doing. So I just think that yes, I'm sympathetic, and I understand that there are you can pull out examples, but I think in the aggregate, the industry has a problem with a lot of these companies.
And Adam, I think there, like anything else, there's a whole degree of, how much this kind of irks people, and based off of how hard of a pivot, companies are going for. You have the truly ridiculous examples where a company crashes and then like rebrands itself as an obesity play.
Right.
But also on like a more legitimate scale, you brought up Galapagos, which, had has to be a record for the largest negative enterprise value ever. And when their first deal, I have the highest respect for Paul Stoffels, but the first deal that he did was a CAR T deal.
Yeah.
And the investors in that company really hated that deal. And it really was a totally different area than what the company had been founded on and worked on forever through like the Gilead transaction. And I think that's really the cases that get people fired up about this. It's like, I invested in you to do this, and now you've taken our investment dollars, which for large investors can not be easy to get out of, and now you're doing something that I'm totally not interested in.
Yeah, and there are ways. Like I said, it's not just about shutting the company down. I mean, look, you can find a merger partner. In the case of Galapagos, now I haven't really followed all the details lately, but the spinco that they're doing. I mean, there are other ways of sort of unlocking shareholder value in some of these companies. Part of the problem, I think, is that we just have so many redundancies. We have so many companies who are trying to do sort of the same thing similarly and doing them badly that you I know it's incredibly difficult to do, but like you can think of a situation where maybe there are assets from several different companies that can be rolled up together. And I know it's easy to say that. It's much more difficult to do those kinds of things, but I think it gets to the broader idea that we need some consolidation. I think, at least on the public side.
Tim,
So Adam, maybe just sharing something that builds on that, and Tim's ears are going to burn here because this is something that we talked about a lot. Is this whole idea of like because you bring it up with with cargo, this whole idea of like an investor mandate, right? Like, do you have like that money when it goes to the company? It's not it's not like that is all the company's money and just purely theirs to decide what to do with. I mean, technically, I guess it is their decision, but it's really like that money came from investors, right? And so do you have a mandate from your investors to like do what you should be doing? And sometimes you get companies that are like, hey, they're below cash, but like their investors like still love what they're doing, right? And we'll talk about Solid Biosciences in a bit, but they were trading below cash for a fair amount of time.
Yep.
And like we were still holders, right? And like a lot of their other investors were still holders, and we liked what they were doing. So what's a way to like test if you have that investor mandate? And Tim and Peter and I had brainstormed about this before, and Tim had some really great thoughts on this, where it's like, hey, what if you do something where you basically say like, look, what we wanted to do didn't work, and so look, you can either get like your shares back, or you can be on your money back, right? And we'll give you X dollars per share, or you can stay with us on this next journey to do whatever. Right? And investors can kind of like walk with their feet or not, right? And those who stay get a larger stake of whatever that next journey is. And we see this with some of the reverse mergers where, what I love that some, reverse merge companies are doing now is you have the shell that's basically saying like, hey, existing holders of the shell, like you can get a dividend or your shares bought back or, something like that. And the new investors are functionally the people putting in the pipe. It's like, that's how it should work, right? The people should choose, right? You want your investors to choose you, not kind of, force yourself, on them. So, just a thought and something that we talked about with Tim a lot.
I think that I totally agree with you. I think that those kind of those sorts of solutions certainly work. I mean, I'd love to hear Tim's take. I think Tim's around on this call. Tim, you have a take on this?
Yeah, I mean, Adam, if anything, I'm even more sympathetic to the kind of the cause of the shareholder than you are. So companies definitely don't spend enough time thinking about their shareholders, and there's obvious agency reasons for that. And, I'll tell some stories. 20 years ago, I was advising Royalty Pharma. There was a huge battle on their board. Like half the board thought the idea of buying pharmaceutical royalties was stupid and they shouldn't continue to do that, and they should just cash out and return the cash. The other half didn't, so us advisors came up with a structure where people could choose to stay in or not. And like half of them cashed out, and I mean, talk about a mistake, right? I mean, that company's value went up like 100-fold from that point. It was a great idea to buy pharmaceutical royalties. On the other hand, in the last couple of years, every time I push this idea, and Tess, you and Peter and I spent a lot of time talking about this. In fact, I pitched it to like RA capital companies, and like you and Peter were fine, but you have colleagues who are like, the weeds on individual companies. It's very hard for them to say, hey, we want to return cash, because it's so hard to get cash. And I have been completely unsuccessful in getting a company in the last 2 or 3 years to voluntarily agree to return cash to shareholders. They will do it with, a gun to their head. And I almost wonder if, like when we found these biotech companies, if we should almost create incentives for management. Or like, if you give the money back, you're going to get a big bonus or something. Because basically, if you give your money back, there's less money around to pay management, right? And no one wants to talk about that. But agency factors are very important in actual real world behavior.
Right. Well, Adam, awesome piece. We could talk about this literally for the whole hour, and I know people will continue to talk about it over Twitter. So thanks a lot, and you're gonna stay and join us for some news items. And
I'll stick around for sure.
Yeah, I'm gonna start with you. So Stoke signed a rest of world deal with Biogen on their Dravet program. Tell us about that.
Yeah, so that deal, what was it? I lose track of time. Tuesday morning, they struck a partnership with Stoke. Struck a partnership with Biogen for for basically ex-US rights, ex-North American rights for their Dravet syndrome drug. I think it had it seemed like it had a sort of a mixed reaction on. I didn't think the deal was so bad. The market disagreed. Stock went down after the deal, but it gives that one of the big overhangs with Stoke as they sort of go ahead to run this phase 3 study that they need to run is there was obviously not a recognition that they needed to raise money to fund the phase 3 study, and it was one of the reasons why the stock had been depressed kind of going into this, and so they did raise the money. It's a non-dilutive way to raise money, selling off a portion of the drug rights, commercial rights. They kept the North American rights, U.S. rights. We can debate whether or not that was a good deal or not. I thought it was, but like I said, I also talked to some people who thought that it wasn't. The idea that this is now an encumbered asset, that essentially kind of dead money, or kind of a company that's now just sort of like now has to go through the paces of running the study, which will take at least a couple of years.
And of course, they were also on a lot of people, I think yours included, a lot of people's buyout lists.
Yes,
and so exactly. Whenever you sign a partnership rather than getting acquired, those types of investors, sell and move on. So there probably was a lot of that too. All right, let's move on. Tess, I'm going to go over to you. So we had some Duchenne news. So Solid seems to be like, the company on Sarepta's heels in terms of the microdystrophin gene therapies. I know that RA is an investor in Solid, but tell us about their data, and it had a very positive market reaction.
Yes, absolutely. So thanks, Brad. So this is a company with a pretty long history. They were founded back in 2014 to develop a gene therapy for Duchenne's muscular dystrophy, and they have seen a lot of ups and downs. So they are one of the, they were certainly trading like a zombie company, for a while. And they released data earlier this week from, a small number of patients, just 3 patients, who'd been dosed with their gene therapy. And, what they showed is average microdystrophin expression of about 110%. Which is pretty remarkable. So when you look at that, compared to, Sarepta's gene therapy, I think, they show around 34%. So high microdystrophin, expression. I think, Pfizer was upwards of 34%. Pfizer's, was discontinued for safety reasons. I think they might have been closer to 50. So high microdystrophin expression, and then, one of the things that was really interesting is that they also showed, some data that, suggested it's obviously still early early, but just showed the potential for some kind of cardiac benefits. They looked at LVEF, for their 3 patients as well. So, this was certainly, I think a positive update for them. And the next step from on what they're doing is really talking with the FDA mid-year about next steps and the potential for accelerated approval.
All right. So this actually brings us. There's another angle to this story that brings us to, I think, another like state and like mechanics of biotech discussion. So I went over there on Tuesday and I interviewed Bo Cumbo about this news. And before I did, I put a shout out on Twitter saying I was going over there and did anybody have any questions? And there was an overwhelming response regarding the way that Solid raised money off of this news. So it was one of these, and we've talked about this before, and I know Adam has written about this before, is one of these situations where they announced the news on Tuesday, but in the days leading up to announcing this news, they confidentially got together with bankers and like a handful of institutional investors and locked in a raise before even putting this data out there publicly. So I think they raised 200 million at $4 a share. And I asked the CEO, Bo, about this, and he had a very thoughtful response. His response was that, look, biotech has been terrible lately, especially in the gene therapy space, and you can't count on a good stock reaction sometimes, even when you have good news lately. And so he felt, given, the position that they were in, that, locking that in with those institutional investors beforehand was the right thing to do. And I think that that's a fair argument. But I would also say that there's 2 counter arguments. Number one, you could argue that those institutions have a vested interest in getting the lowest price possible. And so might not be, their feedback on the data might not be what the actual overall market's feedback was, and you might be leaving money on the table. And so, for example, the stock, has traded north of 6. I think it's in the mid 5s right now, and they diluted a lot at 4 and maybe could have done that at 5 or 6 or 7. But I think the bigger issue, at least that I'm interested in, is, our industry is like the only industry that does raises like this regularly. And a lot of generalist and retail investors have, I think, valid concerns about the fairness of our industry. And so a lot of people are saying, why did somebody else get an early look at this data, and why were they able to invest at such a low I don't have that same opportunity? And I think there's a valid argument on that side too. So I'll put this topic out for discussion too, because I think it's another thing that really, is an important issue about like what it means to invest in biotech. Yeah. Who wants to start first?
Yeah, I'll share some, thoughts with. I think obviously, as you shared, Brad, we were certainly investors in this, in the follow-on that they did after data. I think Bo raises a really good point, where what is the market reaction going to be to data? What are key things to, present and share in the, when you're doing a data release? Sometimes that's not really clear, right? And I think in particular, in the market environment that we're in, where that you have a data release, you certainly want to be able to raise money to get to that next stage. That investor feedback can be really helpful to enable the raise. I think also importantly, it's kind of important to note that for Solid, they did share the data, and then they actually they did the pricing. Later, right? So there was some time for the market to kind of see those to see those data, but importantly, it's always a demand and supply question. So they had to raise, also a very large amount of money, right? And they had a number of investors who they were talking with, and I think an important thing to remember about investors is we're very, very competitive with each other, right? And what's the way to outbid other investors? It is paying a higher price, right? And investors are always able to do that. And when there is a lot of demand, I mean, that is what you see, is you just see investors bidding up the stock. That's what we see in the market every day. And I think that the price reaction that we see, in the aftermath of that follow-on as well, is really a reflection of the company being in a position where they have good data and they're also well-funded, right? But I think that dynamic is a really important one to remember is, yes, sure, every investor would like the lowest price, but also you are constantly being tested on what is the price that you are willing to pay, because you can always get outbid. And that dynamic is ever present. And, indeed, we see that continuing to happen on, financings on a pretty regular basis.
Adam, this raise was very similar to a pipe. And I know that you see the kind of retail Twitter comments whenever we see a situation like this, when there's data in a pipe. What's your take?
I think part of this reflects just the sort of uneven playing field right now in terms of the capital markets, where companies, as Tess said, companies have to raise money. They are sort of at a disadvantage because it's difficult to raise money, so they are sort of at the mercy of investors and funds. And so I like a lot of these deals, and I think maybe Tess can speak to this. I wonder how much, when RA goes out to want to build positions in a company, how much are you building a position in a company in the open market versus going to a company and saying, hey, we'll give you $100 million, but we want it at a discount. You go in and you basically set, you put a term sheet on the desk and say, take it or leave it. I think we're seeing a lot more of that, and the sort of the pipes are kind of that's kind of what the pipes are doing, right? You're not going out and just buying the open market. You're going in kind of, you're going into these companies and saying, and look, and there's some benefits to the companies that do this well. Companies want, they want a good stable of shareholders. So I'm not saying it's not all one-sided, but it is sort of indicative of kind of where the market is right now.
Yeah. Maybe just two other points to add on to that. I do, one is it is actually very difficult to build, a meaningful position on the open market in many biotechs, simply because of volume, right? That there's very limited volume. So that's kind of point one, which is often, for an investor to build a meaningful, for an institutional investor to build a meaningful position, that does require a financing. And then, point number two is, I think, Adam, what you say about, pipes, gee, it would be nice if it were that way. But again, there's always the risk of being outcompeted by peers, right? And that is what creates pricing tension and, allows companies to, really kind of bid things up, right? So I think as an investor, you always have to be careful, when you're, going to a company and saying, here's what we can pay, right? Well, what if you have a peer who's coming in tomorrow and saying, I can pay that and I can, throw on another 10%. You better have been really true about, what you said your pricing sensitivity was originally. And so I think that pricing tension, really continues to exist, for companies. And while, I would say investors are certainly in a, position where there's a lot of companies that are just trading at very discounted values, we're still very much in competition with each other, which, companies should always, just, think about as they're thinking about these different financings. And you continue to see a lot of companies who are just testing that and saying, look, I'm going to put, data out. I'm going to see how the market reacts, and I'm going to use that to raise money. And you may have other companies, particularly, I think, when data is, maybe a little bit messier, where, they might see some benefit to testing that, a little bit beforehand to understand even if there is a path forward, right? Because, for many companies, they may be in a position where they're saying, hey, I could raise money off of these 3 patients, but like, what if that's not a good idea and investors aren't excited and they should really wait until I have 10 or, something like that. So I think that's where some of these, discussions can be very helpful for companies as making that decision.
And Tim, what's your banking perspective on this? And of course, again, like every issue, there's a whole spectrum of like how these look. And, on the pipe variety, we've even seen some where those institutional investors have been given blinded data that nobody else sees, like, weeks or months ahead of like a big, data or medical meeting announcement. And I think those like, really bother a lot of like retail investors. How do you feel about like from a banking perspective and like how needed these things are to get these deals done?
I mean, I think Tess's comments should be taken seriously. And what I mean by that is we are in a free market, right? So the company is going to do what's in their self-interest. The investor is going to do what's in their self-interest. And yet they choose to do these types of transactions. And there's a reason, which is retail investors can't come in and look at, 4 data points or whatever at some biotech company and figure out what to do. But they sure love to jump in once RA gets a crack at it, right? And so if you think of like the IPO market as oftentimes IPOs are underpriced and sort of jump on the first day, these pipe discounts are kind of the same thing where you're essentially inducing the investor to come in and do the work and participate in the deal. And I mean, Tess, your points about the competition are just right on. Yeah, it's highly competitive. And we see that on the banking side all the time. What's so funny is you'll have a company like there's no interest, right? Like no one wants to put in money into XYZ company. You're out as the banker knocking on doors. No one wants to listen to you. You even call your friends like Tess. Hey, Tess, should you look at this? She's like, Tim, I love you, but we don't love that company. Sorry. And then all of a sudden one party's in, and then pretty soon you got like 50 people that want to jump in. So it's a very interesting dynamic, and I do think that there's a method to what appears to be a bit of madness.
All right, let's move on. We had some sad news this morning. Bluebird is doing a take private acquisition. Adam, tell us about some of the details and your thoughts on that.
Yeah, so Bluebird is going to sell itself, or is selling itself, to a couple of private equity firms. I think the deal, minus the CVR, which they have, I think it's about $30 million deal. Not very surprising, to be honest, just given the financial difficulties, because I'm sure you guys have talked about Bluebird and the gene therapy situation there, probably on the Hangout in the past, but we've certainly addressed it at Stat and on our podcast. The company was in a very difficult financial position. They had loans, loan covenants. It seems like now from what they say in the release that they had sort of exhausted all other options to raise money, and so they had to do this essentially what amounts to a take under. The CVR, there's a little upside in the CVR, which is based on potential for sales of their gene therapy products going forward. But, it's a pretty high bar to meet. And it's I mentioned this on Twitter, Brad, and I know you sort of have the same kind of historical perspective with this. Bluebird is a company that was really at one point, kind of at the vanguard, right, of gene therapy. It was a company that, if you go back to like 2013, 2014, they really could do no wrong. They were sort of proving that gene therapy, at least from a scientific basis, was something that, was possible and that could cure patients of these horrible diseases, in their case, sickle cell and beta thalassemia. But ultimately, they sort of ran into the buzzsaw of just the business case and how do you turn these breakthrough scientific achievements that everyone is proud of and everyone points to as the reason kind of to be in biotech. But how do you turn that into a successful business venture? And, it turns out that it's very difficult.
I see Eric has joined us. Eric, you've covered this company for many years. What do you think will be the story of Bluebird at the end of the day?
Well, unfortunately, this isn't the ending that any of us would have liked. And as Adam just articulately laid out, yeah, it's been a long, slow decline that nobody should be surprised about in terms of the unhappy ending today. But there is one silver lining, which is that Bluebird's products are going to, I think, persist under new hands and ownership, of course, but at least persist for those patients with CCALD, thalassemia, and sickle cell disease who sorely do need these options. There aren't that many patients that maybe Bluebird can serve in the future. And of course, many of us, including Adam and myself, have wrote about our skepticism toward the margin structure, the business opportunity, the profitability of these drugs. So we'll see if they can do any better in other people's hands. But at least for the time being, the products will be out there and available to those who so choose.
And I think partly, when I look at Bluebird too, and Eric, this well, partly the problem there is just kind of this fundamental, like, can you, the margins, like you mentioned, just the business case to be made for this particular kind of product. But, if you dig in sort of more granularly into Bluebird, they made a lot of mistakes, things that if you look back, they had some scientific hiccups and setbacks back. If you go back to like 2015, with their first construct, which kind of ran into some trouble, and they had to do, they essentially had to do a lot more work to kind of figure out how to get this thing to be effective, and they had manufacturing issues. There were things that were sort of specific to Bluebird. One of the big things is they did, they just spent, Eric, you remember, they just spent so much money. And, even when people were saying to them, like, why are you spending so much money? And they did. And I think there was this resistance on the part of management there that, they believed in the mission, and they didn't, they didn't kind of heed the call of investors saying, maybe throttle back. And so all those sorts of things kind of contributed to the demise of the company, on top of just this difficulty of making gene therapy work as a business.
There's another angle to this story I've never heard anyone mention. That's something we talk about a lot lately that I think is interesting to note too, is I actually think this is one of the first companies ever, in part, to be wiped out by Chinese competition. I remember very well ASCO 2015, everyone waiting with bated breath for Bluebird to present their BCMA data, and the announcement came out, and at the same time it was like, hey, there's some China company working on the same thing, and like nobody knew that. And today the Chinese company is worth $7 billion, and Bluebird is essentially going bankrupt. And if that Chinese company didn't exist, Bluebird would own the BCMA market right now and probably be worth 7 or 8 billion. And I think that's really, like, historically the first example of that actually happening. So I think that's interesting too.
And Brad, just to jump in on that, if there's one thing we should all be learning in Western biotech, it's that one could probably be a little bit more efficient about how you run a biotech. And
exactly.
I remember talking to Bluebird management over the years, and there was just such confidence that they were doing the right thing. And they're all great people. I'm not saying there's anything wrong with them, but they were just very confident that they had it figured out. And they didn't. And, if there's one thing that I think could be very disruptive is for biotech companies to start to compete on efficiency. And, Tess, I know, like at RA, you kind of preach this a little bit, right? So, like, why don't we try starting the next Bluebird with 15 people and see if we can do that? Because I actually think you could do it, and it could be a much better business model and a way to outcompete the Chinese.
I think that's a very good point. And lastly on this, I don't want to get into this, but in the spirit of picking on like biotech model today, I thought Angelica Peebles, the CNBC biopharma reporter, brought up another thing that really irks people, which is that the CEO of this company over time cashed out like 80 million, and over the course of the company really never succeeding over the long term. And it's a free market, but that also bothers a lot of people. And lastly, one other negative item in the news, and then we're going to go to greener pastures. Tim Septerna, which was an IPO just, I think, in November. It's very similar to the cargo story, has already crashed and burned, and I think reminded people of the risk of the biotech sector. Is there any learnings from this one?
I mean, I don't think Septerna did anything wrong, right? That they discovered that they had a significant bilirubin side effect with one of their drugs. So it's one of the risks that we all take in biotech, and unfortunately they got hit by it.
Yeah. Yeah. And maybe just add, and with an extra caveat that my colleague Jake is on the board here. But, this one, this is, I'd say a growing list of companies that, shortly after IPO has seen some kind of talks, right? And it just reminds us, like, my gosh, like small molecule drug development is really hard. And until you see it in the clinic, there's a lot that you don't know. I think what's interesting and what Septerna, highlighted in their PR is that they've got, multiple attractive PTH1R agonists is what they said that they're planning to accelerate, and they're planning to get one, into the clinic targeting later this year. And it just reminds us of the importance of having backups, right? And I remember when I was working with, Carl DeChico back at Foghorn, him, really preaching that and reminding us, Eliquis was, gosh, it's like how many drugs had to fail before, Eliquis, which was like the backup of the backup of the backup, actually made it into clinical trials and, made it to market. So I think that just a, reminder of how important it is to, we talk about efficiency, right? But efficiency, shouldn't come at the expense of good risk mitigation strategies for, valuable targets.
The other problem here is Tim and Tess both mentioned is that this is a recent IPO, and this is unfortunately at least the second, maybe even third IPO to have blown up in the last 6 months since going public, and that just really wears on biotech more broadly than even the relevance to the few investors who might have owned this security, and casts a pall over the industry when you have companies that are so fresh and new losing money this early. So I just want to chime in here. The sentiment out there is terrible right now in biotech, probably a lot worse than the XBI stock performance or anything else you might be reading about in the papers, and it's because of these types of transactions that just go south so soon. And of course, people are crowding into the same set of names and seemingly, losing money hand over fist on a daily basis. So it's hard out there. Our clients are hurting. I'm sure others on the call are hurting too. And we got to be doing something different in terms of our investment strategy. I'm not sure we're on the right path right now.
All right. Well, we have a lot still to cover. I'm going to try to go through some of these quickly. And let's talk about happier things, of course. Tim, SpringWorks has been in the news. So German Merck KGaA, is in talks to potentially acquire them. And at this point, that's not a rumor. The companies have confirmed it in the media, but it does seem to be taking a lot longer than people may be expected. And SpringWorks had earnings yesterday, and they put the earnings out but didn't have a call or anything. So, I think that says something. But tell us anything you can about that, and just overall M&A sentiment. I saw a headline in the news like a day or two ago that said that the Trump FTC might not actually dial back the pressure on big mergers like people were thinking. What are you hearing in terms of all of that?
I mean, just to comment on SpringWorks, first of all, I don't have any specific information. If I did, I couldn't comment on it. But what I can say is, interestingly, in my PhD dissertation, I looked at the following question. If there's a credible announcement of a merger, that is such and such company is in talk, so this is like credible, it's not some rumor that was in some social media, what happens to the stock next? What I found was, and I looked at about 150 of these over the years, about half the time the merger happens and the stock goes up. And about half the time the merger doesn't happen, and of course the stock goes down. So you saw SpringWorks pop up, which is the right thing. But if you were like a merger arb and you wanted to ask the question, could you make money by buying SpringWorks right now? The answer would be there should be no profit opportunity. So I don't know what's going to happen with Merck KGaA and SpringWorks. It's really going to, obviously Merck KGaA has made an offer, right? So now it's going to be up to the bankers for SpringWorks and the board for SpringWorks. Is this offer good enough, or are they better off continuing to operate on their own? And they have to figure that out. How much time is it going to take? So people see the announcement, they're like, okay, this is going to happen tomorrow. It usually takes 2 to 4 months. And the reason is that the bankers are probably going to keep shopping SpringWorks to make sure that they have the best and highest offer. And they're going to torture Merck KGaA, who's unfortunately now out exposed, saying, hey, we want to buy this company, right? So they're going to be asked the question like, hey, how come you didn't if they fail to? So the bankers are going to use the leverage that they've got.
Hey Tim, from a disclosure, I don't know if you know this, but like from a disclosure standpoint, Merck had to come out and say and kind of acknowledge that there was this there was this interest in the company and that this was
Correct.
happening
Yep.
from I guess it's like some German securities. Or is there like if the deal, let's say the deal falls apart, let's just say like they can't reach terms and Merck decides to walk away, do they also have to disclose that? Do you know how that works?
I don't think they do. We have the same rules in the UK. Where like if you're AstraZeneca and you receive a big offer from Pfizer, you can't just sit on it and not tell investors about it. And it's so restrictive over there because of this thing called the code that you've got to actually be really careful if you're Pfizer about making a merger overture because you don't want to trigger the code. So I would assume that Merck KGaA could just go on their merry way. There's going to be incredible pressure on the board of SpringWorks right now, right? So it's out in the open, and whoever their bankers are, they're working day and night to see if they can get a alternative offer. And I would think that there are multiple bidders in the picture, just because SpringWorks is an attractive company. It's fair to point out that SpringWorks assets are probably not going to get picked up by a large pharma, and that's because large pharma are in general focused on big indications in oncology, and SpringWorks is going after mid-size and smaller indications.
All right, let's keep moving on. Tess, I'm going to go over to you. So, M&A is something that we would love to have as a spark to the biotech sector. And another thing we watch closely, especially in the middle of earnings, is how drug launches are going. And a really high-profile one is BridgeBio with Attruby. And, of course, Alnylam might be in the space as soon as next month, too. Seems to be going okay, right?
It sure does. Yeah, it seems to be going well. This was a launch that I think had a lot of eyes on it. I think there were a lot of people who were pretty skeptical about, another, a small molecule for, ATTR cardiomyopathy, and BridgeBio really, really impressed, having over 1,000, unique prescriptions since, FDA approval, which was really recent, right? So they've just been on the market for really a couple months at this point. And I think this speaks to a broader trend of, companies being able to commercialize on their own, right? And that's something that's, traditionally been really hard. And there's been this like short the launch kind of, philosophy around, smaller biotechs, but we're seeing some real, successes, and, probably a little bit too early to call that completely for BridgeBio, but certainly, looking very strong out of the gate.
And Brad, I want to jump in on your question on M&A. You asked me the same question on like a politician. I just didn't answer it. So M&A we think is going to be pretty strong. I saw the point on the FTC. I think that's going to be okay for most of what we worry about. But One thing we were recently looking at Stifel was how many of these launches are going well? And we saw the same thing Tess just said, which is there's a lot of launches that are going well. And what we noticed is that in almost every case, a company that has a good launch gets bought. That was very striking. You know, try to list out the companies that you know that had launches that beat consensus that didn't get bought. Not many. There are some, but not a lot.
Right. All right, let's keep going. And you can't have a call without talking about obesity. Eric, I'm going to go over to you. Adam's colleague Ling Chen at Stat wrote a really great piece on the obesity space. And her point was, from a patient perspective, not everybody is looking for overly dramatic, percent of weight loss. And I've always felt strongly the same thing. Like now, like whenever we have new data, everyone zeroes in on the weight loss percent. But I think there are other factors like tolerability that are a lot more important. That's where I go straight to when I see new data. Tell us your thoughts on that. And then, of course, we had some news just this morning. The FDA announced that there's not a shortage anymore, and that could affect the compounders like him. So tell us a little bit of a roundup of what's going on in obesity lately.
Sure, Brad, and I may leave that second part of your question to Luba to cover from a more legal aspect. I know she's been following it very closely and probably has much more insight than I. But yeah, on the Stat News article, we couldn't agree more. In fact, my colleague Prakhar Agarwal, who covers the obesity space here for us at Cantor, has been kind of singing the same tune. It's quite surprising that every time a new data set, phase 1 or phase 2, comes out from a novel GLP-1 or combination partner, that the first thing people do is go toward that percent weight loss, and they analyze in excruciating detail and treat a 20% reduction in body mass quite differently, from a 20 or 22%, a 21 or 22% reduction. So it just doesn't make much sense, right? As you said, tolerability is very important. The other thing that's very important, of course, is convenience. And I don't think patients know whether they're losing 20 or 21 or 22% of their body mass. I think they certainly know if they're injecting themselves on a weekly or monthly or maybe even in the future quarterly basis. And I certainly know that they realize whether they're feeling like crap or not on a daily basis because of it. So I think that this whole space has a long way to play out. And that as we start to separate the winners from the losers here, it'll be probably much more on those two latter points, tolerability and convenience, than it'll be on efficacy.
So I just like to add also to that point, happy to cover the legal aspects as well. So I've been talking to and looking at some of the data that is provided by pharmacies like Hims that are providing a lot of the drug, the GLP-1s from the compounding factories, pharmacies. And what's interesting is that the tolerability and convenience is something, it's actually divided into men and women. So women seem to be much more female patients more interested in the complete weight loss, although you're right that does somebody really know if it's 20% or 23% weight loss? Men care a lot more about tolerability and some of the side effects such as muscle loss. So that's actually been interesting as well, and I'm curious how that will affect sales and development of future drugs.
Luba, not to put you on the spot, or if anyone else knows, like, what is now that this has been the FDA made this announcement this morning, what is the repercussions for Hims? Like, do they have like a certain time period that they're still able to do this, or like what's their status right now?
Yeah, so I can tell you, I mean, they knew that this was coming, and not just they knew because of clearly of what Novo and Eli Lilly and others have been saying, but Lilly and Novo have filed lawsuits to force the FDA to declare that there is no longer shortage and to stop distribution of GLP-1s by compounding pharmacies. So this is something that HIMSS has anticipated and knows what's going to happen and has played behind the scenes to, I'm sure, not make that happen. But this is a major blow now to sales. And so, I'm sure that they are going to try to figure out a way to push back. But if the FDA has basically said that's it, and that's their final decision, that is going to be their final decision. They can't continue selling drugs from compounders.
Just to point out, there's a bit of a subtlety here that's not at all obvious. So if you go through the compounding rules, let's say, Brad, you've got some type of disease and there's an on-patent drug that for some reason isn't going to work for you because the
No, that's right. Like dosing.
yeah.
Yeah, you're right. I mean, so dosing, yes, of course, or if you have an allergy to a particular ingredient, but the majority of sales have been because there's the two faction under which you can make the drug and compounding. So you're right. There's going to be a percentage of those people that still can get it, but certainly not for the mass production that they've had before.
So just to point out, if you go through the HIMSS, like go to it and actually try to get your own obesity prescription, what you'll see is that it will very rapidly try to qualify you as a non-responder to currently available doses. And so their business model shifted about 2 months ago to what they call customized compounding. And so Luba, you're right. They've anticipated this. They're one step ahead. The issue that they're going to run into is going to be on the patent side,
Yeah.
right? So it's fine to, like, as you kind of hinted, have some prescriptions that involve alternative dosing, but at some point, if they're, using dosing rules to essentially dodge compounding regulations, they may find themselves in a lawsuit over the Novo patents that they're going to have a tough time with.
Yeah, absolutely.
I saw another really interesting obesity headline this morning. I can't remember where, sadly, but I saw that Eli Lilly has already apparently produced like $500 million worth of their oral therapy that they got from that they licensed from KGaA, and that's before the data, and I think that really goes to show what a big pharma game this is, that they're putting 500 million of drug supply at risk, if there's a chance that the data doesn't turn out to be as strong or successful as they thought it would. And that's a tough thing for smaller biotech companies to do. And we've talked, at length about, some of the acquisitions that haven't happened yet. And I think it just goes to show the investment that's required for even larger companies to potentially compete in this space. All right.
And Brad, before you exit obesity, you should probably mention that while we have been speaking about it, Betaville has a Viking Therapeutics takeout rumor. So there you go. On a Friday, of course, on a Friday.
All right. Let me just scan to make sure we didn't miss anything that was absolutely critical. I think we got everything. We're at the top of the hour. There's actually enough material to do this for a second hour, but we'll kind of stop at that with some of the main news items. I'll give everyone an opportunity to just kind of speak up with any closing remarks if anyone would like to do that. Nope. Okay. Well, thanks a lot for our co-host and for Adam for joining us today. And thanks a lot to the listeners. Look forward to doing this again a week from today.